educate the traders and investors, and in this process we have scheduled 5 programs. The first program I have taken for the intraday trade techniques. Second, the logical and rational way of technical analysis, wherein I have given how mathematically you can analyze the patterns. Every pattern has some mathematics, and also I have informed you each candle pattern also has a mathematics. So every candle pattern has a mathematics, every linear pattern has a mathematics. So I have taken couple of candle patterns and linear patterns for you. So without applying the mathematical concept behind the patterns, it is meaningless. Just if you can say it is looking like a head and shoulder, looking like a double top and double bottom. That was my point to convey, and that was my ambition to inform you. Yes, if you are following any concept, you should follow it properly. So today I'll be taking across to you this fundamentals of stock investment, wherein I'll be taking the ratios which you may use for your investment decision. So after scheduling this event, many emails I have got from some participants. They have written to me to include the PE ratio, price earning ratio, and how to make use of or how to choose a stock based on its PE ratio, though I have not included this topic in today's presentation. However, I'll just give you some rough idea on this, and I will include it in the next session. Whenever next time I am conducting any session on this fundamental analysis, definitely I will go deep into this subject. So before entering to our today's discussed topic, so let us spend couple of time on this, couple of minutes in this PE ratio, how we can make use of PE ratio in our investment decision, price earning ratio. So as you know, this price earning ratio used to vary every day basis based on the price of the stock. So price to earning ratio. So every stock used to trade in terms of its PE multiple. Suppose I am taking 3 stocks from a same sector. Say X, Y and Z are the 3 stocks I have chosen. One is at a price earning multiple of 10. Another is price earning multiple of 15. And next one is price earning multiple of 9. Means the stock price multiplied with the PE ratio. So 9 times of the PE ratio is giving the stock price. 15 times of the PE ratio giving the stock price. 10 times of the PE ratio is giving the stock price. And these stocks are different stocks X, Y, Z. And these 3 are from a same sector. If it is banking, means all 3 should be banking sector. So once we are deriving this PE multiples, then we need to examine the historic data, the past occasions, how they balance each other. So when these 3 stocks have made their all-time or lifetime high, in their lifetime high, so these are the 2 points we have to investigate. So lifetime high. So this is the place how they behave based on their PE multiple. Say in the lifetime high point, the X was at a P multiple of 11, Y was at a P multiple of 11.5, and result was a P multiple of 11.75 in their respective lifetime high. So same way we have to examine how they behave in their lifetime low. So when they met the lifetime low, what was their P relationship, price to earning relationship. So once we derive this conclusion from the lifetime high and from the lifetime low, we have to compare with the current P multiples. So there is a close similarity in their P multiple at lifetime high. If similar condition we are deriving in the lifetime low, then we can say this imbalance of the P multiple is going to be balanced in the future time. That may take some 6 months, 1 year, or 1 month or 1 day. However, they are going to balance in future time. So considering that fact, considering the historic evidence as the proving point, we can say the stock is at a lower P multiple ratio, and we should choose the stock is as our investment basket. So this is one way we can make use of P ratio for our investment decision. Second way, we need to compare the P ratio, P multiple of the stock with the index. When the index was at all-time high, what was the P multiple the stock was quoting, and what was the P multiple the index was quoting? What kind of relationship they established when the stock and the index both are in the all-time high? What kind of P multiple relationship they have established when the stock and index were at the lifetime low or all-time low? So from that two occasions also we need to establish some relationship, and we need to derive the best stock for our investment. Many other way we can use it. So it is a very vast subject, and it is one of the valid subject for the investors. However, in today's event, I am going to take 5 different ratio: Jensen's alpha, Sharpe ratio, Trainer ratio, Schettiner ratio, and alpha. Also, I will be giving you some clue how to make use of volatility with gann square of 9 to make some investment decision. So to start with, first we need to define the investment horizon. So what is our investment objective? How long we want to invest in the market, and what is our time frame of investment? So to my knowledge, the short-term investment objective is only for the 1 month. Every month we need to invest and get some money. So every 1 month horizon investment or lesser time, lesser than 1 month, is known as your short-term investment. Medium term, if you will go for 3 months, long term 6 to 12 months, and higher than that also. And whenever we are following these financial yardsticks like your P ratio, like your earning per share, book value per share, debt equity ratio, so whenever we are following those financial parameters, they never used to prove as the best parameter for our short-term investment decisions. So those financial yardsticks are not the best parameters for our short-term investment whenever our objective is 1 month or less than 1 month. So we need to hold, or we need to hunt for some different ratio or different parameter which can help us to decide a best stock out of a basket of stocks. So that should be our idea. So third, what we investors used to hunt for. Every time, what is our requirement? Whenever we are deciding to buy certain stock, say I am asking you whether to buy the JP Associate or ACC or Gujarat Ambuja or Ambuja Cement. So these three are the cement sector companies. At any point of time, if I wish to, or if I made up my mind to invest some money in the cement sector, so which company I should choose for? JP Associate or ACC or Ambuja Cement? Which one will be my choice? So this kind of puzzle used to disturb us each and every time we used to decide to invest some money in the stock market. That is a biggest challenge for our investors. And this is not a illogical or irrational challenge. This challenge has some value into it. So let us simplify this. So what are the things we need to, so why for this challenge come in front of our eyes? So always we hunt for a stock which is available at a cheaper price as compared to its other stocks, other peer companies. We need a stock which is available at a cheaper price. Second, whether this cheaper price stock has some, or whether the parameter what we are choosing to, or the parameter we are using to choose a cheaper stock, whether those parameters has ever yield any success in the past, or ever they have given any good result in their choice. That is also matters much. So here cheaper price stock is our aim. Our goal is to choose a best stock out of a basket of stocks which is available at a cheaper price. And the financial parameter what we are going to use, whether they have produced any good result in their past study. So these two things I am going to attend for you. So the ratios what I have chosen today: Jensen's alpha, Sharpe ratio, Trainer ratio and Certina ratio. So this Certina ratio I am not taking for you today because it involves great deal of mathematics. It involves the integration. It involves some derivative functions, so which all may not be in a position to digest. So for that reason I am just avoiding this one. And in my earlier seminars also, webinars also, I have avoided this ratio. So in this subject, in these 5 ratios, I have been giving you the information from the month of March 2010. From the March 2010, continuously every month on month basis, we are going on giving you the stuffs in the same ratio. So those recordings you can find out in our website. So in fact, I'll just take one past example here. And so what I have done here, I have taken 3 stocks for my chosen. Out of these 3 stocks, 1 stock I need to invest. So for the month of July, I will be investing for the month of August, July 2010. Data I have taken. My investment will be in the month of August. So the basket of stocks consisting of State Bank of India, HDFC Bank and ICICI Bank. Out of these 3 stocks, any one I can choose for my investment, or I may choose 3 stocks but in the proportion of 30% or proportion of 50-25% based on my logic. I may choose it. So I may distribute my capital in these 3 stocks. So the cheaper stock I will invest more, next costly stock I will invest somewhat lesser than the first investment basket, and the last part I will be investing in the costliest stock. I will be investing very less. That may be my choice, or I can choose only the cheapest stock and invest in that. So I have taken the State Bank of India and HDFC Bank. So I will be calculating the Johnson's alpha, Sharpe ratio, Trainer ratio. Also I will calculate the alpha, stock alpha also. So these 4 ratios I will be calculating, and the formulas I have already given here. The Johnson's alpha can be calculated: return on stock 1, average return what the stock 1 has produced, minus simple interest what the RBI has fixed, plus stock beta into return on the stock 2 minus interest rate. So this is the Johnson's alpha of stock 1. Similarly, for the stock 2, 2 stocks you have taken. So for the stock 2, you will be taking return on stock 2 minus interest rate plus stock beta return on stock 1 minus interest rate. So this is the formula for Johnson's alpha. Sharpe ratio, return given by the stock, any one stock, stock 1 or 2, 2 stocks you are comparing, minus risk-free interest rate divided by the annual volatility of the stock. This is the Sharpe ratio. Trainer ratio, reward to volatility ratio, return on stock minus risk-free interest rate divided by beta of the stock. So these 3 ratios, as per their theoretical perception, it is given that higher the ratio, better the return. But when we apply it in the practical context, we often observe lower the ratio, better the return. Stock which is having the lower ratio is to produce better return. The reason is the lower ratio means the stock which is producing higher return is already being factored. Already it has been factored and it has already been awarded that return. So now these are the 3 basic formulae of Johnson's alpha, Sharpe ratio, Trainer ratio. If you wish to, you can take a note of this. Then second part is alpha. So how to calculate the alpha? The average return produced by the second stock minus beta of the stock multiplied with the average return produced by the first stock, X and Y stock. And beta has a formula also, n into sum of X and Y minus sum of X into sum of Y divided by n into sum of X square minus sum of X whole square. Or you can use the other formula, covariance of X and Y, covariance of X and Y divided by variance of X multiplied with n divided by n minus 1. So n is the number of days what you have taken for your study. So n divided by n minus 1. So covariance by variance multiplied with n divided by n minus 1. So this formula also you can use. So variance of X. So this is also you can use. And alpha says that if the X and Y produces positive alpha, then X is overpriced. If it produces negative alpha, then X is underpriced. So which stock we should make X and which stock we should make Y? Because whenever we are comparing two stocks, one should be at the X place, one other should be in the Y position. So which stock should become X and which one should become Y? In that case, you need to take the help of their annual volatility. The stock which produces higher annual volatility should be treated as X. The stock which produces lower annual volatility should be taken as Y. So that is the standard procedure of making a stock X, or putting a stock in the position of X and putting a stock in the position of Y. So by that process, I have taken the State Bank of India and HDFC Bank for the 1st July to 30th July and my investment decision for the month of August. So I have taken every day the 1st July, because before that there was no record, because only July month data I am examining, and the second day onwards I will be just noting the percentage change this stock has given in terms of percentage change, what are the gain or loss it has recorded. So that is I have calculated. So second day's price, 2nd July price minus 1st July price divided by 1st July price multiplied with 100. So by this process I have calculated the percentage gain or loss given by this stock. Then I have taken the average gain and average loss. After calculating this average gain and average loss, I have to calculate the volatility also along with this, and volatility already I have explained this calculation of volatility in the first day's webinar program, how to calculate the daily volatility and how to calculate the annual volatility. So here we have calculated the daily volatility, then yearly volatility will be daily volatility multiplied with square root of 365. So the HDFC having a annual volatility of 22.68, SBI having annual volatility of 23.6445. Henceforth SBI should be X and HDFC should be Y. Then I have taken the covariance function here. N is 22, so 22 days are there, 1st July to 30th July, 22 trading days. So 22 trading days are there. Then I have calculated the beta. So beta is nothing but your covariance divided by variance multiplied with n divided by n minus 1. So this is n divided by n minus 1, and beta is covariance by, this is the covariance by variance. So you can see here covariance of X and Y divided by variance of X and Y. So covariance divided by variance multiplied with X and Y. So this has given me the, multiplied by n divided by n minus 1, which has given me beta. I have calculated the beta, I have calculated the volatility, so which is required for calculating the alpha. So alpha is the average return given by the stock Y, average return given by the stock Y minus beta multiple of average return given by the stock X. So this is the alpha. Jensen's alpha, same way I have given that formula for you. Interest rate we need to take. So Jensen's alpha for State Bank of India, this plot. Jensen's alpha for HDFC Bank. Sharpe ratio for State Bank of India, Sharpe ratio for HDFC Bank, Sharpe ratio for Trainer ratio for State Bank of India, and Trainer ratio of HDFC Bank. This is what we have calculated, and based on that we have to make a choice. So whenever you are going to choose between the alpha and Jensen's alpha, any one you can consider, not both. Either you can consider alpha or Jensen's alpha. So I have taken this Jensen's alpha. So State Bank of India having the lower So here my choice is SBI is the best choice to invest. Here Sharpe ratio says that State Bank of India is having lower Sharpe ratio, so this should be taken for investment. Trainer ratio also lower for the State Bank of India. Henceforth, here all three ratios are suggesting to invest in the State Bank of India, and all three are denying to invest in SDFC Bank. So let me check once more with the ICICI and State Bank of India. Here, whenever I am taking the SBI and ICICI Bank, I found out the yearly volatility is 26% for ICICI and 23% for State Bank of India. Henceforth, ICICI should be treated X and SBI should be Y. So from here also we have concluded ICICI is the best choice to invest as compared to the State Bank of India. So ICICI should be chosen between ICICI and SBI. ICICI should be chosen. Now same way we have compared ICICI and HDFC Bank. Here ICICI is having the higher annual volatility. Henceforth it has taken as X, and here too we have get ICICI. So our choice goes ICICI is the first choice. ICICI is the first choice. State Bank of India is the second choice and HDFC is the last choice. This is what our selection may be. So this is what our selection of the stocks: ICICI, State Bank of India and HDFC Bank. These three stocks should be arranged in this order. ICICI Bank, State Bank of India is the next choice and HDFC is the last choice. When we will see in terms of their return, in the month of August, ICICI has given 8.5%. HDFC, which was costliest among all three, has given the lowest return. SBI, which was second costliest counter, it was the second cheapest counter among these three, has given 10.46, which you can say close near to this. So 2% variation has come here. However, the costliest counter has produced the lowest return. HDFC has produced the lowest return among these. So this is what we have got from this ratio. Now same test let us do with the April month. So we have taken March data and we have to do the testing for April. State Bank of India and HDFC, same way we have taken, calculated the annual volatility. State Bank of India is annual volatility 34%. This is 24.76. So State Bank of India should be taken as X and HDFC should be Y. No change here. And here Jensen's alpha suggests that it is negative for State Bank of India, positive for HDFC. So State Bank of India is the choice in terms of Jensen's alpha. Sharpe ratio suggests that State Bank of India, it has a lower ratio. Trainer ratio also suggests State Bank of India because it is lower. Then we have compared between State Bank of India and ICICI. Here State Bank of India is having higher annual volatility. That's why we have changed it to position X. Previously in the month of July, it was State Bank of India was placed at the position of Y because it was having lower volatility. Now its volatility is more. Henceforth it has taken the position of X and ICICI has taken the position of Y. So from this also we have concluded State Bank of India, State Bank of India and State Bank of India. Three things we have concluded. Now we need to calculate or compare between the ICICI and HDFC. So here we are getting a very interesting result. The Jensen's alpha suggests that ICICI is the choice. Sharpe ratio suggests that HDFC is the choice. Trainer ratio is suggesting that ICICI is the choice. and alpha we are forced to take here, because out of these three ratios, one ratio, Sharpe ratio, which is being divided, so which is giving a opposite view. So we have taken the help of alpha. What the alpha is suggesting? Alpha is suggesting HDFC. So out of these four ratios, two ratios are in the favor of HDFC and two ratios in the favor of ICICI Bank. So these ratios are now neutral, because 50% view is in favor of HDFC, 50% view in the form of favor of ICICI. So both are equally, the equal weight is there between these two stocks. So both are having the probability to produce equal return. Both are having the probability to produce equal return. So henceforth, we will be concluding the State Bank of India is the best choice for us. And if you compare with the 31st March to 4th April, State Bank of India has gone slightly negative return it has given. HDFC Bank given plus 2.34 and ICICI has given slight positive return as compared to the 31st March closing. So from this analysis I can conclude I have a great chance in the State Bank of India. Based on the return produced by HDFC and ICICI Bank, since both are equally weighted or both are having the equal chance to produce equal return, equal chance and equal return, based on our last phase of analysis. So I can conclude that the second position should be given to ICICI Bank and the last position should be given to HDFC Bank. So let us go with this fact and let us see what kind of result we are getting at the end of April. Yes, this ratio analysis has produced good return in the month of August. Same way, same analysis has given good return in the month of September, October, November till February. The same thing has, same concept has given us the best choice. So let us see what kind of return it is giving on the month of April. So month of April, our best choice goes to State Bank of India. Second choice comes to ICICI Bank based on the current scenario, and third choice goes to the HDFC Bank. So we have made a choice between these three stocks, but where to buy, where we should purchase, which is the price which confirms that yes, now I should buy. And what is the final target for a month I can get? What is the estimated target? So what is the estimated target or expected target? As asked by Anand, now what is the expected target and when we should buy? So these two things I will discuss in the second part of the session, wherein we will be taking the help of our volatility and gann square of 9 will, or with volatility and Fibonacci principle, any one principle we can use and we can conclude the estimated target of our best stock and the price point where we should make an entry as per the volatility situation. So before that, spend a couple of minutes to understand about Smart Finance product and service, and after that I will join and take this part.
Thank you. Dr. Meeta joining you. Good evening, everybody. We'll have a look across the products of Smart Finance. Though this webinar is part of our free educational service of Smart Finance, we too have various paid services too, which is the requirement of the business. So Today we are witnessing Ranjan sir's lecture on the successful investment technique. This we will be getting in our investor course, which is having the latest edition, where in the book we are giving you the technical analysis volume 1 book, and that contains the in detail description of this technique of investment. That will cost you 1500 rupees along with 3 DVDs. Besides the other products, we have technical course, 3 DVDs and 1 book costing 1500. Elliott Wave course, 3 DVDs, 1 book and 1 software with lifetime validity costing 1500. Fibonacci technique same, and gann course same. Future and option we have 1700 rupees for 3 DVDs, 1 book and 1 software. Volatility based software and ebook cost you 1700. One of the best products for intraday technique, commodity trading and forex trading too. If you want to obtain all these courses in toto, then totally it will be 18 DVDs, 6 books and 5 software costing you 10,900 rupees. However, the discounted price is 8,100 rupees. And none of our software will be having any maintenance, or there is no expiry. It is a lifetime validity for all softwares. All the courses contains the concerned topics with the mathematical derivation and with the Indian market frontline stock examples being written by mentor Mr. Ranjan. He is the author of all the books. The DVDs explain his lecture on the concerned topics. Studio recorded lectures are available in that. Softwares are being developed by Mr. Ranjan too. As you know, she is the youngest Indian who is the author of 6 books on capital market as of now. She is the person to give Gann's hexagon, to decode Gann's hexagon principle. And he is the innovator of beta decoupling technique, the never failing technique for future trader till date, since years back when it was given to the public domain. And so many things you can explore in detail once you go through his products. We used to conduct seminars also, which is offline and online. Now upcoming event going to take place for 12 days. It is an online seminar starting on 23rd of April. There we have theory classes of 7 days where Mr. Ranjan's lectures will be given to you, and 5 practice sessions during market hour where he will be giving the various clues of those techniques, how they undergo slight modifications under certain circumstances. So in front of the live practice hour, live market screen, the best advantage of these techniques can be learned by the participants. Today what we are listening the financial arithmetic for investors. This can be even explored more during the webinar coming on this 23rd April, where he will be taking few classes on this topic too. There is a course fee 8,000 rupees without material and 13,000 with material, where you can obtain all the above given material worth 8,100 rupees. If you wish to have registration in this program, feel free to log on to our site under seminar link available. You can, there itself the links are available to register, or else you can call for any kind of query to our given number 044 6499 5823. Any product related query, feel free to put in the chat box. I'll be attending it.
Next task is to choose a price point where we should buy it and what is the estimated target. So I will be taking for the same month of April, because this we may use for our trade. So State Bank of India is the best choice for our investment between these 3 stocks. So as a disclaimer, I confess I do not have any position on this stock, neither in the futures and options segment nor in the holding terms. Maybe my clients will be having. So I do not have personally any holding on that. So as of today, as of 4th April 2011, it may change tomorrow. So the estimated price point we need 34% is the yearly volatility. Daily volatility already we have counted here. Daily volatility is 1.79%. So let me take the monthly volatility. So 30 days volatility I have to take. So this is the daily volatility multiplied with square root of 30. So this is going to give me the monthly volatility. So this is not in the percentage term. This must be multiplied with 100 to give me in the percentage term. So 9.85% speculation or oscillation I am expecting in this stock in the month of April. 9.85%. This may come in 1 day, this may come in 2 days, this may come in the, you can say, in a net terms towards the end of the month. So when it happens, that I do not know. I do not have idea when it will happen. So in the rupee terms, how much money I will be getting? So 9.85% divided by 100. So it gives me 272 rupees. So let me put in the March last traded price. So 272 I have added. So I am expecting in the upper side 3034. In the lower side, if it is slipping below, I am expecting at 2490. So this is what my expected targets as per the volatility, considering there is a return of 9.85% is sitting or waiting for me based on monthly volatility. So 3034 and 2495 is the expected range. So now we'll use two terms here. The first term is Fibonacci. The way we have used for the intraday, same way we will be using here. But here 0.382 will not be taken. So 0.272 will be the best ratio for our choice. So 0.272 times of, where the first ratio crossover is very crucial for us. So 74 points, if it is climbing, then we can say trend is up. So to identify this trend, so 2.72 to 0.272 retracement we have taken. Above 2836, it has all probability to touch 3034. If it is slipping by 2762 minus 74 points, so if it is slipping below 2688, my trend is down. So here trend is down and here trend is off. Trend is up. So trend is down and trend is up. So trend is down and trend is off. This price points we have got. Once we got the trend and we got the final target, we can, considering this 2836 as our best price point to enter the trade, we should enter and aim for 3034. Considering this is the trend down, we should enter here as a short trade, but short we cannot do in the cash segment. Rather we have to go for the stock borrowing window. We can sell and borrow some stocks from somebody and give it in the delivery. So stock borrowing window is active in some counters. If your broker allows you, then you can do it. So sell the stock at 2688 and you can aim for 2490. So in this both the cases, what will be your stop loss? So your stop loss is very crucial. So since you are an investor and the depth is too high, 74 points is the depth. So keep the stop loss as at 2762. In the absolute terms, you should take 2762. So 2762 is your stop loss point. Come out, wait for the 2688 to happen, then enter the trade. Now the price is at 2758 level. Let it cross that 2836. Then you should enter. So this you can do. This you can do. Now, this is the price point you have got in terms of our Fibonacci 272. Why I have taken here? Because it's a very interesting question. Somebody has asked why we have taken Fibonacci 0.272. In the Fibonacci sequence, 0.272 is the starting ratio. It goes to 0.382. It goes to 0.5. This is not a Fibonacci ratio 0.5, but we have taken it in the Fibonacci domain 0.618, 0.786. So these are the retracement ratio beyond which 0.888 also is there, beyond which 100% retracement, beyond which expansion ratios will come 1.272, 1.618. So whenever we do the intraday trade, this 0.272 should not be trusted. So it should go beyond 0.382. Whenever we need to do some investment, at least more than 10 days time frame, our investment horizon is for more than 10 days time frame, then this 0.272 is valid enough to take. This 0.7272 is valid enough to take. So second approach, let us take the Elliott approach. Elliott approach. The Elliott approach already I have given in the Elliott wave ebook, free ebook, which is distributed in our website. So Elliott wave free ebook. Wave 1 is a 0.382 times of its prior swing. Wave 2. So wave 2 is a counter wave and it can retrace 0.618 times of its prior wave. Wave 3. So wave 3, it has 1.272 times of its wave 1 of wave 1. So this is just I am giving you a small recap of this, and wave 4 is the 0.618 times of your wave 3, and similarly wave 5 is having the same length as wave 1, same length as wave 1. So wave expansions and other things I am not considering. Wave expansions and certain fine-tuned rules are there that I am not considering. I am just using the Fibonacci proportion. What is the Fibonacci proportion behind the waves? So with the help of this, if I wish to take some trade decision, so what will be my price? What will the price point I should enter a trade? So 0.382 times, the first point will be 272 is the price range, 382. So 0.382 times of this, it is giving me 104 rupees. So first the wave 1 will start from 2762 added with 103. So 2866 it should end. This is the end of wave 1. Wave 1. And from there wave 2, this is the place I should not purchase. From here the wave 2 should start. So wave 2 will be having 0.618 times of your wave 1 length. So this will be 0.618 times of your wave 1 length. So this is the price point your wave 2 will end. So this is the end of wave 2. So what I'll do here, I'll wait for the stock to touch 2866, then there should be a retracement till 280. There should be a retracement till 2802, which has not yet come. So then there will be a retracement till this 2802. This is also the starting point of wave 2. So this is the place I should buy. So once I am purchasing here, what will be my ultimate target I can fix? So first target will be 1.272 times of wave 1. So wave 1 is having 103 rupees. So till this point, so this is the point my wave 3 will end. This is the price point my wave 3 will end. So this will be my first target. And second target I can take ultimate as at 3034, which is fixed as for my volatility. So this is the second approach. As per the Elliott also I can invest. As for the WT gann, so gann square of 9 will I need to use these two price points. So the first price point, whenever I used to make any buy decision, so this here the square of 9 will let me take you across to that square of 9 will. So as for the gann square of 9 principle, so how we can make use of that? So let me open that. So this is gann square of 9 will we are supporting with the gann course package. So this is the square of 9 will. Let it open. So here our two price points what we have got. The first price point from where our calculation will start is 2762. It has probability to go for till 3034, or it has the probability to come down to 2490. So this is the two probabilities we are having. So if you are using the gann square of 9 principle, if you wish to make some buy decision, so the first price should be low. So the first price must be low. So this is the 2762. This is the price point we should start, and we have the probability till 3034. So I can do this thing, and the third price point, ending point, we should purchase. So purchase price is set at 2845. Stop loss will be 2765. And this is the seed number of the gann wheel, and targets 7688, 2906, 3020, and the final target is 3034. So this is as for the gann square of 9. So this is square of 9 constructions and other things, procedures you can get it the gann course. So, and you too get through some web resources. So this is how these three approaches will be guiding you to make some decision where to make purchase, and volatility will give you the finest clue where will be your final target as per the current volatility situation. So this is how you can make the best choice of the stock, then use any one of this method to get the desired result. If anybody has any question, can put it now. But out of these three concepts, I always favors the gann square of 9. So in terms of its result, gann square of 9 is to give good results for this short-term investment. Second comes to this Elliott. Third goes to Fibonacci. In three concept has their own success and failure, but gann square of 9 has the best success among all these three. So if anybody has any question, can ask now.